Hi friends, my name is Deepak, and today once again I have Sanjiv Gupta, CPA, with me. As you guys know, Sanjiv is a prominent certified public accountant. His office is located in Fremont as well as Sunnyvale. He has a new office coming up in Pleasanton as well. So those of you guys who've been looking forward to that office, we know we get a lot of phone calls, so that should be a good news for many of you guys. We have a live event coming up next month. I would like to invite all of you guys to join us for that event. It's going to be a full day event from 10 a.m. to 4 p.m. It's going to be happening in Santa Clara, and food will be served courtesy of Park Baluchi. So that's a new restaurant, it's a very high scale restaurant. They are currently open now, and they will be catering that day. So that'll be a very, very exciting event. Obviously, seats are limited, so I will urge all of you guys to go ahead and go on our website on sanjeevcpa.com and register for that event as soon as you can. So that way you guys get your tickets before the events get filled out. And one more thing on this topic, by the way, if you do need to cancel your ticket for that day, do let us know, because there's only limited number of seats and somebody else can definitely use those seats. And every single year we get sold out on that event and becomes so hard to get the extra people in. So do me a favor, if you're not going to show up, just let us know so that way we can reassign those seats to somebody else. But that's what's going on with us. But today I want to talk a little bit about 401k plans, IRA plans, basically retirement plans. And Sanjeev ji, I want to give you a simple example. I recently hired a financial consultant to help me out with my retirement plan. And this financial consultant supposedly was an expert in doing all kind of different investments for me. And he said, I'm going to charge you 1%. And by the way, if you guys have a financial consultant working with you, chances are that's what they told you, that they're going to charge you 1%. And he will earn me better than what I can earn in an open market. So that sounded like a good plan for me. 1% is not big. If he can earn me 12, 13, 14%, market earns me 8 to 9%, why not? So I went ahead and hired the guy. And a couple months later, I looked at my statement and I saw that he actually charged me 5%.
Wow.
Instead of 1%. I call up the gentleman and he says, well, you know, I didn't mean to. This was an accident. But now that I have already charged you, why don't worry about it. It's all good to go. In future, it will produce you better return. And I said, okay, tell me your strategy. How are you going to produce me better results? I mean, what is it that you're going to do differently if I paid you 5% versus if I paid you 1%? And you go like, well, I'm going to have a financial consultant look at your portfolio. I'm like, but I thought you were the financial consultant. And you're like, no, I have other financial consultants. I'm like, then why am I paying you? I should be paying the other financial consultant.
Right.
Long story, it kept going on and on. The guy didn't have a good answer for me. Then he says, you know what, let me get back to you the next day. Fair enough. Give the guy some time. Let him get back to me next day. I went back into his office, and he had this nice little booklet printed out for me. On the booklet, it shows how much money he was going to earn me over next 15 years. Looked very nice. The numbers look good. I'm like, wow, this is a great guy. And then I asked the next question. Obviously, I've been trained by Sanjeev here, so I know what to ask. I says, why don't you show me another booklet that shows me how much I'm going to pay you in fees over next 15 years? He carefully eliminated that information, but once I asked for that information, and obviously he has to provide me at that point, I looked at the numbers, guys, you're not going to believe it. It was 50% of what he was going to earn me. 50%. That's how much you might be paying in fees and expenses onto your retirement plan. You tell me, how can you possibly think about retiring wealthy if you're paying 50% of that into fees to somebody else? Not all people are like that, and he's a great guy, by the way. It's not, I mean, I'm pretty sure that's just the way he does business. But nice guy. You talk to him, you meet with him, it's just a nice guy. And so I'm pretty sure the guy you're working with is a nice guy. But that doesn't mean that your 401k is in order. So I will strongly recommend that you take a look at that statement, bring it to Sanjeev or his staff, let them help you figure out those miscellaneous numbers. And you'll be surprised how easy it might be to discover $100,000, $150,000 in fees just by looking at those statements. So Sanjeev ji, that's what I want to talk to you today a little bit about. That is 401k plans, IRA plans, retirement plans, and these fees. This is like a big topic these days.
So let me, first of all, I want to first appreciate this fact that you have at least looked into your 401k plans. So many clients come to my office. The first question I ask them, you have 401k? Yeah, I have 401k. I have from 401k for my employer. The next question is, did you ever look at your 401k allocations? Oh, no, I just did on Fidelity, I just did there. That's pretty much it. I do here and there some numbers. Did you really look into the statement? I don't have time. I have to do my job. What about your wife? She's also working. She also has a job. So you're working for making good money. You're not making the money work for you, because inside the allocation, inside those 401k, there are a lot of fees, like you said. That's why, if you remember, the Congress has made this rule that all these 401k fees needs to be upfront now. So at this statement now they are telling all the fees upfront. They cannot hide it. So one has to be really careful. Now let me ask you this: you get a Social Security statement. You used to get a Social Security statement. Now that statement is gone. How many people used to look at the statement? And I know that whenever they used to look at the statement, they say, "Oh, I'm going to get $50,000 when I retire, or $60,000, or $1,500 a month." It was not really make sense. They are not going to get $1,500 a month. It's just a statement showing if you continue to work for this many years, for 30 years, then you may be eligible.
And moreover, if I'm not wrong, they assume that you will also have X number of growth
Yes.
in earnings as well.
Yeah, earning as well.
Which you may not.
So we always see the numbers, but we don't read the fine lines. So it's very critical that you are lucky that you are looking into your stuff. I want everybody to look into their 401k allocations and make sure the fees are not like 20% or 50% like in your case. Like that's really something
No, but
never heard of.
And I know Sanjeev ji is laughing about this, but let me tell you this, friends. The way that was my point of view, that
Right.
I was surprised, but from his point of view, the way he was looking at it, what an idiot. Why does he
Yes.
care? Everybody does the same thing.
That's something, yes.
So, what according to him, he has 1,500 clients and nobody ever says anything.
See, that's the thing. That's why I'm pointing this fact that we have to be careful about those. Now, coming to the 401k IRAs, we a lot of people are confused which plan to adopt for. So I will divide this category. I will divide a person into different categories depending upon what they're doing. First is W2. Second is a small business owner having 1099. Third is the corporation setup. So for W2 employees, see, they have not much choices. They have to go with the 401k with their employer. They have no choices. Of course, when we talk about 401k, the next question comes into our mind is, hey, what happens? I'm on H1, I'm going back to India. I really am. When the person say, I don't want to invest because I'm going back to India, they don't want. You're working. You're working hard. You're getting money, but you're paying taxes, and you don't want to save taxes because you're going back to India. It's just doesn't work out. 20%. They are in 20%, 25% bracket. They lose about $5,000-6,000 in taxes, just because they are thinking they are going to go back.
Which is optional.
Which is optional and never happens. I've seen people coming to my office for 10 years saying the same thing. I want to go back. I want to go back. They have kids also. They grown-up kids also. They still keep on saying, I want to go back. So we have to realize this. We have to save taxes today because that is what we earn, and we want to maximize the money in our pocket. So we should take the full advantage of 401k given by the employer, 17,500. On top of it, if the employer is contributing, that's a free money. I've seen people saying, employer is not contributing. Why should I contribute? You should contribute full list. Don't worry about the employer contribution because you save 20 to 25% of the whatever you're contributing. If your rates are higher, if your earnings are higher, you save more. So that's the first thing. 401k for the W2, 17,500. Now, when you change jobs, I've seen that too a lot of times. When you change jobs, you don't carry a 401k. You keep on having the 401k with the old employer because you think it is easy. You just keep it there. Forget. Now, the old employer will not. Why the previous employer will care much about your 401k? They might change the administrator, trustee. They might change the trustees. There might be more fees. There might be more changes inside the. What happens if the employer goes bust or the bank goes bankrupt? So all these things are vital. Don't keep the old 401k with your previous employer. Roll it over to your new employer, or roll it over to a rollover IRA, where you can have more options, better options, then 401k, right? You can invest in stocks, you can do a lot of stuff. You can invest in real estate. So you can do a lot of stuff in rollover IRA, but the only thing is you should be careful. You should be knowing all those things. If you think you're not savvy and you have no time to understand this, just roll it over to your new employer 401k, right? See if they offer better options inside that, but you're in control of that for rollover. Don't take the check in your hand when you roll it over. If you take the check, you will get a 1099 statement from the IRA, from this broker, from the trustee, and make sure the distribution code should be there. Is 1, 2, 3, or 5 or 6. Every distribution code has a significant impact on your taxes. People do make mistakes in that area. So that's 401k rollovers or 401k. When it comes to small business owner 1099, they have a lot of more options. They can be SAP IRAs, is self simplified employee pension plan IRA. It can be simple IRA. It can be solo 401k plans. Of all these plans, solo 401k, which is known as individual 401k plans, that's the best. Why? Because you can put up to $49,000 as compared to $17,500. You can put up to $49,000 in those plans. So that's a good plan. So if you are working on 1099, you can do up to 49,000 of your income. The way it works is 20% of your net profit from your 1099. So if you have a 1099 income, then you minus all your expenses, travel, automobile, telephone, all these other expenses and business expenses, and then net this net you take 20%, put in a solo 401k plan. And solo 401k you can divide it 100% for the employee portion, which is 17,500. Rest is 20% of net profit. That's how it works. So that's a good plan.
And just for illustration, let's say if you were earning $100,000 on 1099, which I know a lot of IT professionals are, that means you can put 17,500 as an individual, and then providing you didn't take any deductions, $20,000 from employer portion, so you end up putting in about $37,000.
37,000. That's a saving of at least 25% on that. Count is $7,000 to $8,000 in taxes just by doing that. So for 1099, this is a perfect way. Solo 401k is a perfect plan to have. Now coming to the corporations, when we talk about corporations, right, one man owner or two man owner, husband wife owning or friends owning, it will depend upon how many people are there in the corporations. Like again, if it's husband wife, you can do solo 401k for both of them. You run payroll, like we talked about earlier in the earlier segment about this S corporation part, where we can take, let's say profit is $100,000, we run a payroll 50,000, put 50,000. Well, you can run 50,000 for each of husband and wife. Out of 50,000, you can put 70,500 full into solo 401k plus 20%, 25% of the payroll now. So 25% of the payroll is 50,000. That's 12,500. So each person can put 17,500 plus 12,500. That's $30,000, $60,000 in total, out 100,000 profit in solo 401k plan. So that's a great savings. So we should look at the solo 401k plan for corporation. Now, if you have employees, definitely you can't do solo 401k because it's an individual 401k plan. We have other options, like you can like simplified employee pension plan, where they have to be eligible for getting that benefit. H1 people, if you're an H1, you're disqualified. You're not counted as one of those people when you do the SEP IRA plans. So the employees needs to be eligible for participation. So if they are not eligible, let's say for example they have to work at least for 2 years. If they are not working for 2 years full time, they are not eligible to participate. Then you can participate fully. So there are rules governing the rules are there governing those requirements. If you pass those rules, you can do SEP IRA, right? So definitely, so you understand. So we have a 401k. We talked about the business for solo 401k. Now we're talking about a traditional IRA. If you don't have a business and your employer doesn't have a 401k, what options we have? We have a traditional IRA. What is that traditional IRA? It's the same IRA like a rollover IRA with some distinctions, but you can put $5,000. This year is $5,500 per person into those plans. So you can put $11,000 husband wife with no 401k plans into that plan with no AGI limit. The last but not the least is a Roth IRA. Now, Roth IRA is a tax-free event. Now, when you say tax-free, is after tax money going into that Roth IRA, that needs to sit inside the Roth IRA for 5 years, right, and then can be taken out. The contribution can be taken out anytime, or the income should be sitting there for 5 years. If you take out before age 59 and a half, there is a penalty. If you take out after 59 and a half, is penalty free. There is no taxes because it's after tax money. What is the benefit of Roth IRA? See, we have to think this way. We have to have a good tax deferred accounts and a good tax free accounts when you retire. Because what happens when we retire, if you take money out from tax deferred accounts like a 401k plans or solo 401k plans, definitely you are going to pay taxes that time, right? It's not tax free. And you can't take too much money out because then your tax rate will jump up that time. So you have to mix bag of tax deferred accounts, tax free income, and Social Security on top of it. You don't want to pay taxes on Social Security, so you have to plan in such a way you have a mixed bag of all these three elements. Of course, the Social Security should pay what we are eligible at that time. 2037, they are targeting like they will pay only 75% or 50% of the eligible amounts, but that's good amount. So we have to plan in such a way that we pay less taxes and get more money in our pocket. Remember, we will not be working that time.
Now, Sanjeevji, you covered quite in details the rest of the film, but Roth IRA, who qualifies for Roth IRA?
Good question. So Roth IRA, what the rules are, there are limitations on contribution to Roth IRAs. Maximum, like if you have AGI, let's say 160k or 170k, you cannot contribute after, like if your income exceeds, you cannot contribute to Roth IRA. If you can contribute up to maximum 5,500 this year. But there is one more element which is known as non-deductible IRA. What is a non-deductible IRA? It is a traditional IRA, but because your AGI limit is higher, it becomes a non-deductible IRA. There is no income limit. You put the same amount in non-deductible IRA, and it's a backdoor entry. You can convert that to Roth IRA later on, anytime.
So this is for people who are high earning wage.
They can put, everybody can put into non-deductible IRA 5,000 each.
This is on top of their 401k?
Yes.
So they're putting it.
Because there's no income limit. There's no requirement for 401k. The only thing is you have to file a form 8606 with the IRS because they have to keep in account the basis calculation. Because what happens is, if you mix the bag, like we have said earlier, traditional IRA also there. So when you convert to Roth IRA, that time you can only do a proportional conversion with non-deductible IRA and traditional IRA. You can't just convert non-deductible IRA fully into Roth IRA. You can do only proportion. So it's important to understand those implications. But if you do properly, you can put a lot of money into these plans, and these plans are made for your benefit. We should never think, oh, I am going to go back. See, if people come from there, they have a PPF account in India.
Right.
Why they have PPF account in India?
If they're going to come here.
They are going to come here.
So friends, what I would like to stress out here is this would be a great time to do this kind of planning. You can't plan these things next January or February. That you can do next year. But for this year tax return, this is a great time to meet with Sanjiv or your tax professional and plan out these things. So that way you can take action right now. We are in October. You got November and December, a couple more months left before we start running into a tax season. So this will be a great time to put those things on paper, figure out how much taxes can you save. And a lot of times, common question comes in, I don't have money to do this. Right, Sanjeevji? That happens a lot. But take a look. If you put that thing on a paper and says, okay, you know what, if I don't put that money in this, how much tax I would end up paying.
Right.
And if I put that, how much, I mean, it's better to pay yourself than paying the government, I guess.
20-25% saving.
Isn't it?
Even a credit card is not so, like, its interest rate is not so high.
So that's why I say it's important for you to do the numbers. If you don't know your numbers, come into the office, speak with one of the tax professionals or Sanjiv. They can help you out, do your numbers, and kind of put everything in perspective for you. It's a great month to do that kind of consulting. Well, Sanjiv, thank you so much for clarifying that for us. It made a lot of sense. Now people know about all different options they have available and how they can take advantage of those. So friends, you can always reach Sanjiv ji at his office. That number is 510-825-7563, 510-825-7563, or you can visit him online on sanjivcpa.com. Once again, he's a certified public accountant. His office is located in Fremont. I also have another office in Sunnyvale and a new one coming up in Pleasanton. He does tax consulting for both individuals as well as business clients. Also does consulting on international matters. So if you have a company or you're an individual with some sort of foreign asset, Sanjiv will be a great person to consult with because he understands both sides of the stories. He used to be a chartered accountant in India, so he practiced taxes there for several years before coming to the United States. So he really do understand taxes in India as well as in the United States. But thank you so much for watching, guys. We look forward to seeing you next time. Hopefully you'll be at our next event, and maybe we can meet up face to face there. But till then, thank you and goodbye.